Welcome to Daybreak Australia. I'm Paul Allen in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Asia getting a positive lead-in with yields falling as the US Treasury cuts its quarterly borrowing estimate. The Nasdaq gaining ahead of earnings from tech megacaps. Oil markets in focus as the Biden administration seeks a response to the attack on US forces in Jordan that won't trigger a regional escalation. Plus, Evergrande's liquidation order posing a big test for international creditors as Beijing presses cities to help ease the property downturn.
Well, let's take a look at how we're shaping up for this Tuesday trading in the Asia Pacific. Take a look at the ASX there, already showing some modest gains. We do have the staggered open, of course, but today could be the day that we see a record on the ASX. You see at the moment we're at 7580. The number to watch, 7632 for that all-time high. We've got yields falling very modestly. We'll talk more about that in a moment. And the Aussie dollar rising as well, breaking through that 66 cents US level. Let's take a look at what else is going on across the region. New Zealand's been trading for a little while now, and we've got the NZX right now just losing a little bit of ground, off by about 1/4%. The Nikkei looks to be setting up for another positive session. We did see some modest gains yesterday as well, although the yen strengthening just a little, and I use strengthening as a relative term, 147.50 at the moment. Futures for China in negative territory, and we've got rather used to that story, Belle.
That's right, Paul, but what's really interesting, the flip side of that, or the other story we're also getting really used to, is just the amount of gains that we've seen in US stocks over the course of this year. So we saw the S&P 500, for instance, crossing that 4,900 mark in the prior session. That's a record high for the US benchmark. The Nasdaq as well, we saw it gaining as much as 1%, and that's ahead as well of key earnings we've got this week from Alphabet, Amazon, Meta, Microsoft, more. It's a really big few days ahead for that market. A lot of investor focus, of course, on those numbers. You've got the Fed decision, a lot of data with the jobs report, but the moves today really very much focus as well on the action in the bond space. And we had, of course, the US Treasury surprising traders, and it all came down to it cutting its quarterly borrowing estimate to $760 billion, Paul.
Yeah, let's get a little bit more on that pullback in US borrowing. Bring in our chief rates correspondent for Asia and MLive contributor Garfield Reynolds here in Sydney. So, Garfield, we've seen the yields declining on the back of that news. Which part of the curve's looking more vulnerable here?
Well, the part of the curve that's looking more vulnerable now is the short end, because this has really emphasized. So this was one of like the three big risks for bonds coming into this week. This one turned out not to be a risk. We didn't get the increase in expected borrowing, which many had been looking for, which might have sent yields up like across the curve, but especially further out. That's usually where things like supply risk have a bigger impact. So now bond markets are going to pivot rapidly towards what does the Fed say tomorrow. That's more about the short end of the curve, because we're waiting to find out whether or not we get those rate cuts, or more sort of when we get those rate cuts and how many of them we might get. And that's very much the sort of thing that matters more for the short end of the curve.
Garfield, just give it a little bit more context on what markets have been expecting, the numbers that came out, and also adding to that how it really sets us up for the quarterly refunding announcement from the Treasury later this week.
Yeah, well, markets have been looking for something like more than 800 billion as the borrowing estimate. Came in at 760 billion, which was well under most estimates. And the interesting thing is that a lot of that has been driven more by an improvement in where the Treasury's cash reserves are now and what went on in the last quarter. It's not because there's been an improvement in the current fiscal situation. The deficit is still getting larger, but as I said, they're in a better position with what they've got on hand. They're also looking forward to the second quarter, and it's looking like kind of a return to normality. In the second quarter, often the Treasury ended up traditionally paying down some of its debt, because that's when you get the big tax receipts coming in. So the expectation for the second quarter is that they'll have like a very small actual kind of net borrowing need. So there's that's going on. What we are looking for with the actual announcement, though, is a slight increase in some of the longer-term note auctions. 10-year in particular might actually increase, but this is sort of seen as being the last hurrah. This is like the last increase for a while, and the market is going to be less concerned by that increase in the auction size, at least to start off with, because the picture going forward looks so much less concerning than many had thought it might.
All right, that was our chief rates correspondent for Asia and MLive contributor Garfield Reynolds there. Let's get more perspective on that. Joining us is Belita Ong, chairman at Dalton Investments. So, Belita, there are some strategists out there saying that Treasury refunding has more market-moving potential than the Fed this week. Where do you sit on that view?
Thanks for having me back. We are not experts at U.S. monetary policy or fiscal policy, but of course we have to watch it because it impacts everything else. With that said, it seems that the Fed is on hold for the time being, pending further data. And what they're looking for is some sort of sustained path towards their 2% goal. So for the time being, I don't see monetary policy being much of a factor in the markets until at least the March meetings. With regards to the Treasury refunding, it's clear that they will have to increase over time. So the path toward it might be uneven because it's seasonal, but the deficit's growing and the refunding packages will have to get bigger. So the question I think maybe we should think about is that despite the depth and liquidity in the Treasury markets, will we get to some point where global investors will tire of buying U.S. Treasuries and cause an increase in interest rates for the U.S. Treasury? So we'll have to wait and see that. We've already seen a marked decrease in holdings by Japan and China, of course. And we'll just have to keep an eye out on the ongoing liquidity of the Treasury market.
One of the factors that, of course, plays into demand for treasuries is geopolitical risks. And which ones are you watching in particular?
Geopolitical risks are impacting everything at this point. So the two hot wars that we're looking at, especially the one in the Middle East, is of particular importance because it affects the price of oil. And that tends to be pervasive in all production supply chains. So that's very important to watch. The thing to watch, of course, is Iran's participation or growing involvement in this crisis, which could be very bad. And I think that's probably the most relevant concern geopolitically on markets, but because of its impact on inflation. With regards to other geopolitical risks like the U.S. elections, they'll come and they'll go, and the likelihood is that there'll be increased divisiveness and bigger deficits ahead. So, we might get a reprieve if there's a Republican president who chooses to try and end the war in Ukraine by not providing support. But, whichever way it goes, the U.S. is essentially a growing deficit country. And without some sort of comprehensive plan as to how to reduce that deficit, there'll be pressure on interest rates going forward, I believe.
Well, more presently, we do have a Fed meeting coming up this week. Of course, no change expected, but those bets on March rate cuts have also been receding as well. Bearing in mind some of the geopolitical risk you're talking about there, are you reevaluating your expectations around timing and how many cuts we get?
I think that the Fed's dot plot is a good way to look at what might happen this year. And their dot plot calls for 3 cuts this year. And I would think that it would start later than March, but I don't know. It all depends on the data we get. There is some concern about employment from the most recent data we've seen, which shows that with the earnings reports that have come out for about 20% of the companies reporting currently, we've seen something like 13% of them talk about layoffs, which is unusual. It's an unusually high percentage of companies talking about layoffs in their financial releases. And a more typical number is something like 7% in a strong growing economy. So perhaps we'll see some weakness in the employment numbers going forward, but we don't know. It could be all sorts of factors causing that change, such as AI or the fact that people were hoarding capital before this year. So we'll just have to see how it turns into the employment numbers.
All right, Belita Ong, Chairman of Dalton Investments. You're staying with us. We'll come back to you in a moment for some of your market views and investing strategies as well. But still to come, Washington seeking a response to the deadly attack on US troops in Jordan without sparking a wider war in the Middle East. We're going to hear more from the US Defense Press Secretary later on this hour. First, though, we'll talk about the downfall of China Evergrande and what its liquidation means for China's property sector. This is Bloomberg.
Now that a Hong Kong court has ordered the liquidation of embattled property developer Evergrande, the big question is whether that decision will be followed in China, where the bulk of its assets are located. So for the latest, let's bring in our chief North Asia correspondent, Stephen Engel. And as you just said then, this is really the point it gets interesting now.
It does get interesting now, because now what happens, right? Because there's a Hong Kong court order for the liquidation from the Hong Kong court yesterday. Will that court order be followed in the mainland, where there's a different legal system, obviously, which obviously takes direction essentially from the Communist Party. So if there's a dispersal of these assets, is it going to happen in China, right? Because essentially there's no precedence for a large company like this with a spaghetti bowl of different assets and liabilities and priorities and international bondholders and different kinds of creditors. Who's going to be left with the lion's share, and who's not going to necessarily come out of this very happily? And will it undermine, essentially, because look, the bonds and the shares are traded here in Hong Kong, but the bulk of those assets, $242 billion of assets, are located on the mainland. So how does this get divvied up in a liquidation that is ordered in Hong Kong? So it's a very complicated process, because generally speaking, this doesn't happen in China, an outright liquidation. It's something called an open disposal, where there will be essentially debt restructurings going on behind the scenes while the company will continue to operate, albeit maybe on a restricted basis. HNA Group is one example, that big sprawling company that got into many different businesses, but mainly Hainan Airlines and Hong Kong Airlines and the like. That process took 4 years, and it was a bit messy as well. There was criminal proceedings and the like. That's probably the closest analogy that we can get. But Evergrande, who knows how long this potentially can take. We're already seeing He Lifeng, the economic czar in China. He had a meeting. He basically calling on all the municipalities, the cities across China to follow the central government's orders to pretty much return discipline and follow through on central government policies to clean up the property mess, because the property mess is leading to the stock market mess. It's leading to a lack of confidence in China overall. So again, there's lots of issues to talk about, Annabelle, because one thing you think about if this is going to be contagion to others, and whether there's not going to be any white knight coming in, meaning Beijing coming in to rescue any of these insolvent developers, you have to look at things like pre-sales that are in escrow right now. And He Lifeng mentioned this. Those pre-sales, which a lot of these developers needed for financing and then dispersal into other higher yielding assets or investments, he's warning city governments, you watch those pre-sales that are sitting in escrow in case they are dispersed elsewhere, if you know what I mean. So basically raiding the cookie jar while authorities are trying to figure out how to unwind what was one of the largest developers in China.
Yeah, so I know this is a tricky one, but what kind of timing are we talking about for this unwinding? And when it happens, is it going to be like we usually see with an unwinding and a liquidation? Are the usual people going to be at the front of the queue this time?
Well, everyone's going to be putting their hand out and saying, what about me? Obviously, we saw that as well, with the coupon payments over this whole process. Dollar bondholders, let's face it, we're probably getting the short end of the stick here. So, again, it's all going to depend on if mainland courts back up what the Hong Kong court did yesterday. And that's how long is a piece of string? I oftentimes use that analogy because we simply don't know how long this is going to take and whether there's going to be compliance to that Hong Kong court order in mainland courts and those mainland assets. It really we can't tell. Eric Ju, he'll be on later on. Bloomberg Economics. He thinks it could be 1 to 2, 3-year process. I mentioned to Annabelle, HNA process took about 4 years to unwind and essentially be restructured into what it is today. Again, it's going to be a long process, definitely.
All right, and you'll be covering it all for us, I'm sure, Steve. That was Bloomberg's chief North Asia correspondent, Stephen Engel there. Let's bring back Belita Ong, chairman at Dalton Investments. And Belita, I think really the pessimism surrounding China is pretty much entrenched at this point in time. But are you seeing any opportunities out of that instead?
I think it's still early. There's so much that's wrong with the economy and the financial structure of businesses in China that it certainly bears watching, because the market is cheap. And there are good companies, and it's 1.4 billion people who are hardworking, disciplined, and a government with resources. So it certainly bears watching. So we're looking, which is something we haven't done in a long time, but we're not yet finding. It's it's early, and I think the way that this bankruptcy, the Evergrande bankruptcy, works itself out will be very interesting and instructive, and it will either assure foreign investors that they will be dealt with fairly or not, and perhaps will also sort out where people stand in terms of their ownership of unfinished apartments in China. So it certainly bears watching.
When you say that you're not finding any opportunities just yet, what exactly are you looking at? Is it sector specific, or is it more the price story?
So we've been out of China for a long time. We essentially started getting nervous about China when Jack Ma was hauled in. So that was in 2020, very long time ago. And for the past year and a half or two, we've had no exposure in China, none whatsoever. What would bring us in is some sign that there's a return towards a market where minority shareholders will be fairly treated. So essentially, permission or practice by the government not to interfere with the workings of a capitalist system. So that's a lot to ask for, but perhaps we could get something, a little bit closer to that than where we are now. The valuations are good, and some of the businesses are good. But we have to know that the managements of companies we invest in have the interests aligned with ours as minority shareholders. And we look for that.
Where do you see the yuan heading, and how's that influencing your strategy when it comes to China?
So the yuan is, it's interesting. It's undergoing pressure because of foreigners taking capital out. But it's possible that the Chinese government decides to let it devalue, which they have so far resisted, to stimulate exports. The problem with that is that you typically want to do that when you have an economy where your balance of payments are out of whack or where your currency is too strong, which is not the case in China. So when you apply a solution of devaluation, you're seeking a short-term solution that doesn't help with the long-term, because that's not where your currency belongs. So they could do it, and they did. We would look for, and we are looking for, companies that might benefit from stronger exports. But I think there's plenty more they can do before devaluing the yuan.
I want to move to a market where you're feeling a little bit more optimistic. That would be Korea. I know you see a number of quality companies trading at a discount. Can you give us some ideas there?
Sure. Korea is an unloved market and has been for quite a while. And it's because of widely publicized corruption with the chaebols. The thing to bear in mind is that in Korea, something like 75% of household wealth is in real estate. And that's reflected in a soaring real estate market and pretty heavy financial debt on the household balance sheet. So the Korean government, seeing that what can happen what's happened in China could happen in Korea, so they're quite nervous about this imbalance of assets allocated to real estate. So they really want to try and encourage their public and their pensions to invest more in the stock market, which has been languishing for over a decade. And they've actually taken some steps to try and improve things. So President Yoon, in his first public appearance showed up at the opening day of the Korea Stock Exchange and essentially talked about how he wants to remove the Korea discount. And his reforms that he talked about included simplifying the tax treatment of investing in stocks, so removing stamp duties, removing capital gains on tax on stock investments. He talked about reducing estate taxes, because it's really the high estate taxes that have caused the chaebols, the controlling families, to keep prices low. So that's really dampened the performance of Korean stocks. So if you reduce that, then you have more of a shot that the controlling families will allow the prices to increase. So that's also helpful. These measures, if they are taken together with some of the things that Japan has done, which has helped the Japanese market, such as most recently the naming and shaming list of companies that haven't conformed to behaving well to shareholders, could really help to restore confidence in the Korean stock market. The other thing that's happening in Korea too is that by taking these steps, it's getting the Korean stock market ready to be accepted into the developed market index, which is a big deal because many investors invest based on indexes. And if you can get in there, Goldman Sachs has estimated that it will bring in something like $55 billion immediately. And going forward, there should be a sustained inflow of capital into Korea. So that's also very helpful. So there are many things going on in Korea that we think are interesting.
All right, Belita Ong, thanks so much for joining us, Chairman at Dalton Investments. And you can get a roundup of the stories that you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to Daybreak Go. It's also available on mobile in the Bloomberg Anywhere app. And you can customize your settings so you're only getting news on the industries and the assets that you care about. This is Bloomberg. You're watching Daybreak Australia. Here are some of the latest corporate headlines that we're tracking. Elon Musk says the first human has received a Neuralink brain implant. In a post on X, Musk says the patient's recovering well, with initial results showing what he calls promising neuron spike detection. The startup aims to create a computer-brain interface that will initially enable people with paralysis to control external devices with their thoughts. It's raised more than $500 million in venture capital since 2016. Shares in iRobot tumbled after Amazon scrapped its planned $1.4 billion takeover of the Roomba maker. The companies say the deal has no path to regulatory approval in the EU. iRobot also announced its CEO, Colin Angle, is stepping down as it embarks on a restructuring plan that will cut about 31% of its workforce, or 350 staff. Golf's PGA Tour set to be close to finalising an investment from a US consortium led by Fenway Sports, known as Strategic Sports Group. It includes New York Mets owner Steve Cohen's family office and former Milwaukee Bucks co-owner Mark Lazary. Sources say the initial investment could be about $3 billion, with an additional tranche from the Saudi Public Investment Fund. We have plenty more to come on Daybreak Australia. This is Bloomberg.
You're watching Daybreak Australia. Just getting you some breaking lines that are crossing the terminal now. Japanese employment data, and what it shows us is that the market remained relatively tight at the end of last year. So the jobs to applicant ratio, you can see there, edging just a fraction lower to 1.27 from 1.28. So the estimate from economists had been for the gauge to stay flat. But it does mean that there are 127 jobs being offered for every single 100 applicants. So it tells us there's still a shortage of workers, and we're seeing that across a lot of different sectors in Japan. The question, of course, is whether that leads to higher pay levels. The unemployment rate, meanwhile, we saw that coming in at 2.4%. The prior reading had been 2.5%. So again, just a slight change there, but certainly something the Bank of Japan is going to be watching very, very closely, because they do want to see a cycle develop here where you have higher wages, and then that links to demand-driven inflation, and that promotes higher salaries in turn, and so on. So certainly something for them to be tracking ahead of their next decision. Let's take a look at how that's feeding into any sort of market action today, because we have another one to note on the data docket, and this is retail sales as well that are due in the next hour. But so far in the session, we're setting up for some modest gains here across the board for the most part. New Zealand, a little bit of an outlier there because we're seeing some weakness, and US futures there you can see trading fairly flat at this point in time, but crossing above that key 4,900 mark and hitting a record high in the prior session. A lot of that really being driven by these surprise moves from the US Treasury, so cutting their quarterly borrowing estimate to $760 billion. That had a big implication for yields as well. So, Paul, really quite a busy action-packed session, especially when you think we're also on watch for Aussie stocks to hit a fresh record high.
Yeah, that's right. Closing in on that number, the number to watch there, 7632. We're also watching US officials who say President Biden seeking a response to the deadly attacks on US forces in Jordan that's tough enough on Iran and its proxies while avoiding a wider conflict. US Department of Defense Press Secretary Major General Patrick Ryder spoke with Bloomberg earlier.
We will take deliberate, appropriate action. Our focus here is not to broaden a conflict from the very beginning. We've been very focused on ensuring that the situation in Israel does not broaden into a wider regional conflict. Unfortunately, what you have here are Iranian proxy groups that are exploiting the situation and conducting these types of illegal attacks against forces that are in the region to actually preserve peace and stability. So, again, we're going to do what we need to do to protect our forces while also cognizant of the fact that what we don't want is a wider regional conflict.
General, who were the perpetrators behind these attacks?
Yeah, so what we know right now is we are very confident that these attacks, this particular attack against this facility was by Iranian-backed proxies. We're working through the actual attribution piece right now, but of course it carries the signature of Kataib Hezbollah, which has conducted attacks in the past. But this is something that we continue to look at specifically.
And when you look at this, just for people following this and listening to what's been developing in the Middle East over the last month or so, how big is the difference between those groups and Iran themselves?
Well, for a long time, Iran has used proxy groups around the region to enable itself to have plausible deniability, enable itself to implement policy, and importantly, to essentially try to expel the United States and other countries that are at odds with its own policies and views from the region. And so this is, in a large part, what you are seeing in Iraq and Syria is that these proxies, and to a degree Iran, exploiting the situation, the tensions in the Middle East in an effort to try to expel the United States and the coalition from Iraq and Syria. And again, those forces, particularly in Iraq, are there at the invitation of the government of Iraq to assist in the lasting defeat of ISIS. That is the mission that we're there for, and that's what we continue to remain focused on.
Does Iran have plausible deniability this morning?
Look, we know that these groups are backed by Iran with the support of Iran. They organize, train, and equip these groups, and we will hold them accountable.
You will hold Iran accountable or these groups accountable? And I think, Major General, as you know, this is the issue. Which one is it?
Look, again, I'm not going to telegraph or forecast our response. We know that Iran is behind these groups. We're not seeking conflict with Iran. We don't seek war with Iran. But again, we will take necessary measures to protect our forces, and we will respond in a time and manner of our choosing.
That's US Department of Defense Press Secretary Major General Patrick Ryder there, speaking with Bloomberg's Jonathan Ferro. If we take a look at the oil price right now, West Texas 76.95, giving up some of the ground that we saw yesterday. But for more on this, we're joined by Daniel Hines, Senior Commodity Strategist at ANZ, joining us now here in Sydney. Daniel, we are awaiting a response from the US. History suggests it typically happens around about this time. What are you anticipating, and is history any guide and usefully forecasting where the oil price goes from here?
Yeah, well, I do get a sense that the geopolitical sort of risk premium that we've seen in oil markets does seem to be abating a little bit over the years. I think the reaction to these types of events are becoming less and less pronounced on oil prices, and I think the market, is certainly in this period is taking a bit more of a cautious view around the risks around supply, but certainly those risks have risen sharply, and I think I suppose the escalation of the conflict and potentially Iran and the US becoming involved more directly is what the market is really concerned about. I do feel, though, that both sides don't want this to end at that point, and I think that's how the market is viewing it at the moment. But it does feel like it's a slippery slope, and we're being dragged into it. And I think the fact that we saw an oil tanker hit last week just brings to home the real risks. If this does become an uncontrollable sort of escalation, and the implications for the oil market are quite significant.
Yeah, and interestingly, a Russian tanker targeted as well. We'll leave that to one side for the moment, but we do have a chart on the Bloomberg terminal showing that time spreads suggest that there is more tightness coming to the market. We do have an OPEC Plus online meeting in a couple of days. Do you expect to hear any response from OPEC Plus in terms of this?
Look, I think there'll be a wait-and-see approach taken by them. I do note that the data so far suggests that the cuts we've seen in the early part of January have been relatively limited, but they're going to walk a fine line. I think Saudi Arabia in particular wants to see cuts from other members before they really start to pull back the lever on their side of things as well. But yeah, I think the fact that we're now seeing an increased number of ships moving away from the Suez Canal, pushing around Africa, does ultimately lengthen the time that oil's on the water, and thus restrict supply and tighten the physical market at the moment. So that's probably what we're seeing to date. But the oil price is obviously not reacting as a consequence of any sort of longevity to that type of issue.
Just coming back to that observation I made about the Russian vessel getting targeted, and this is after Houthi rebels said, look, it's only ships with connections to Israel. Does that promise now look a little bit empty to you, and does that change your thinking at all? Yeah, no, I think any sort of link, be it quite diverted, I suppose, is going to result in these tankers being targeted. So yeah, I do think it changed the view of what could potentially happen to oil supply through that route, and I think the market has subsequently pushed prices up to reflect that, but it's not, I think, a wholesale change which would only come if we do see the US and Iran become directly involved.
Wanted to shift a little bit to another sector that's focusing or seeing some sort of supply side issues, and that's the metal sector as well. So what are you watching there in particular?
Yeah, this has gone a little bit unnoticed because we haven't seen a real sudden sell-off which has instigated this. But the price sensitivity of the market does seem to be quite high at this point. And maybe that's a result of the balance sheets of a lot of resource companies which have grown thin over the past few years. But certainly the reaction to the weak pricing has been quite strong and quite quick. We've seen it in copper, we've seen it in some of the critical minerals, and even in markets like aluminium and the like. We're starting to see signs of that emerging. I think for us it'll be about how obviously further high cost supply reacts to the current situation. Certainly, it is under pressure, and I think the market is doing what the market does and naturally rebalancing it. If we do see that occur at the same time that demand rebounds, and we do expect to see a more positive second half of this year, then that's when we'll start to see prices react. But for the moment, I think with Chinese growth easing lower, the supply disruptions, the supply closures, I suspect will have to continue for that market to rebalance.
Yeah, I wanted to pick up on that point around China. What are you expecting really in terms of their demand? Is that what you think will drive that pickup in prices in the second half?
Yeah, well, I mean, we're certainly seeing demand from new sectors really support overall consumption at the moment, despite, I suppose, that broader sort of weak economic backdrop coming from obviously clean energy technologies, the EV market, renewable energies. They've all been relatively strong and are sort of hitting quite sizable levels now to have an impact on overall demand. But clearly, with GDP growth threatening to fall, below 5%, maybe towards even towards 4%. The broader sort of manufacturing and construction sectors are going to see some weakness, and that's going to be an issue in the shorter term. I think we'll see other markets start to rebound though and fill up some of that gap. So we're looking to India and maybe some of the developed markets that get through this. This initial period of tighter monetary policy to come out the other end relatively okay.
All right, that was Daniel Hines, Senior Commodity Strategist at ANZ. Thanks so much for your time this morning. Let's get a look at some of the other geopolitical stories that we're continuing to track around the world. And Qatar says negotiations to free hostages taken by Hamas during its October attack on Israel are making progress. Prime Minister Sheikh Mohammed Al Thani says talks are moving to a place which could lead to a potential permanent ceasefire. Qatar is the key mediator in talks between Israel and Hamas.
Right now, I will describe it the progress that we are making in the last couple of weeks is we are in a much better place than where we were a few weeks ago.
The Biden administration is warning that it may restore sanctions on Venezuela's energy sector. That's if the government upholds its ban on opposition candidate Maria Corina Machado from running for president. Existing sanctions were suspended for 6 months through April. Sources say Washington will consider other measures if Machado is kept off the ballot. We've learned Russia is considering an indefinite suspension of wartime capital controls. The measures are aimed at easing pressure on the ruble after international sanctions over Russia's war in Ukraine. The restrictions require exporters, including oil producers, to repatriate 80% of their overseas earnings. 90% of that must be sold for rubles. Still ahead, China's economic challenges may put a dent in its energy transition plans, but Bloomberg NEF thinks the momentum for renewables will continue. Find out why next. This is Bloomberg.
Despite the headwinds buffeting China's economy, Bloomberg NEF expects the nation's power demand growth to remain robust this year, and that's as energy-intensive industries, including solar and EVs, continue to grow. BNEF's head of China research, Nanan Ko, joins us now for more. So, Nanan, talk to us about the outlook on China's power demand for this year.
Yeah, actually, last year, China has been navigating through the headwinds of economical challenges. So, at the beginning of last year, everybody was expecting a much slower growth, but it ended up with 5.26% of economic growth. And talking about power demand growth, last year everybody was expecting 5 to 6% growth, but actually it ended very high, like 6.7%. So, this was, as you said, this is like through energy intensive industry as well as very high-tech manufacturing. And this could be attributed to a series of incentive policy that was being carried out in July. So these policies actually have been effectively boosted the power demand growth. And all these policies are designed to last for 2 years. So the effect will extend it to this year. So that's very promising, the most promising reason that we think the power demand growth will continue to at a very healthy rate this year. However, we'll see like the growth rate will probably be a little bit more lower comparing to last year, because we think the low base effect because of the very low demand growth in 2022 will dissipate. So this year we're looking at somewhere like 6% of power demand growth into 2024.
So against that sort of backdrop then, Anand, what's the most interesting development to watch in China's energy market this year? And then in turn, how could it impact the rest of the world?
Well, thank you. So this year, I think the most interesting story to watch about China is about this surging demand for solar capacity addition. So last year, we already see a very, very high growth. So the growth last year was 145% higher than the growth in 2022. And to put that into perspective, what China has added in 2023 is more than the entire addition from 2020, 2021, and 2022. So this surge in demand of solar addition is definitely elevated the industry expectation. And I think there are also more optimism factor that we think this year's growth will be even higher. So one, because the falling prices make more economic, financially viable. And second, China has a very sufficient and efficient supply chain that could enable a massive deployment of the solar capacity. And third, I think the Chinese government has raised this year's target by 25% compared to last year. So such large demand in China will have a profound impact globally. So the demand here, the massive demand has attracted a lot of investment into the supply chain. And that has not only brought new technology, but also has driven down the cost. So the globally will enjoy very low module price with even higher efficiency globally. So that could also help the everywhere globally for even higher solar installation this year.
So do you believe that China's on track to reach its carbon emissions peak in 2024?
Yeah, that's a very interesting question. The answer is yes or no. So whether China could energy power generation emission could peak this year depends on several factors. So we are already talking about a little mild growth this year, and the massive wind and solar addition last year will also contribute to that. But there is a factor that is really is very, very important, but usually underevaluated. That is the recovery of hydro production. So in the past 3 years, China's hydro production continued to drop in the past for three years in a series. So this year, some early indicators saying that the water dam is full of water this year. So we're expecting a surge of the recovery of the hydro generation this year. But this effect could not last into next year. So maybe China this year, the coal production will peak or won't grow compared to last year, but this situation is unlikely to happen next year. So we are going to see China's power sector emission to continue to grow for a few years until it peak before 2030.
All right, Anand, thanks so much for your time. That was Anand Ko, Bloomberg's NEF's head of China research there. And you can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. We've got less than 10 minutes until the start of trade in Tokyo, and Toyota is going to be one of the companies we're going to be watching at the start because it's temporarily suspended shipments of 10 models due to testing issues. Let's get more from our auto and aviation reporter Supriya Singh joining us from Tokyo. So Supriya, just kick us off here with telling us what exactly has happened.
Hi, so Toyota just found out that its subsidiary Toyota Industries had been issuing certificates which were not true. They were rigged, and the finding came after the investigation started with the forklifts that Toyota Industries used to produce, and the investigation then led to the diesel engines used in Toyota Motors cars. And when they found out that the certificates were not up to the mark, Toyota decided to suspend the production of 10 of its models And yesterday, Toyota President Koji Sato pointed that the problem lies within the in the communication in the company, where the ground workers are not able to communicate properly with the management, and hence these issues have been happening not only just with Toyota Industries but Daihatsu and Hino, even other subsidiaries of Toyota.
So what's Toyota's plan to resolve these issues?
Well, Koji Sato yesterday said that they're going to make a system where the voice of ground workers is heard properly. And then he also pointed that the problem actually lies, if we look at all the three subsidiaries, the problem lies at the understanding of engineers toward certification. So they need to raise the understanding towards certification and build a system where management, where the communication is proper between the ground workers and the management. Other than that, they said they're going to rebuild the whole management in Toyota Industries and make efforts, but no specified plans are out as yet. We're expecting Toyota to give comments maybe today or very soon regarding the issue.
All right, auto and aviation reporter Supriya Singh there. Some of the other stories in the auto sector that we're tracking: BYD's earnings rose on the back of soaring EV sales, but fell short of analyst expectations. Now, that's due to a price war in China hitting the bottom line. Sales in China helped offset a decline in global demand, lifting BYD's preliminary 2023 net income by at least 75% from a year earlier to about $4 billion. GM's boosting its quarterly dividend by 1/3 to 12 cents a share. The payout will come on March 14 for investors holding shares on the 1st of the month. The announcement came ahead of the car maker's quarterly earnings report due later on Tuesday. Market opens in Seoul and Tokyo are next, also watching for that potential record on the ASX. More in a moment. This is Bloomberg.